Most people who have life insurance have no idea if they actually have enough of it. They either picked a number that sounded reasonable or took whatever their employer offered and never really questioned it. And honestly, it's not their fault. Nobody ever sat down with them and walked through how to actually figure out the right number. So that's exactly what we're going to do here today. Later in the video, I'll also show you a simple way to estimate the right coverage based on your specific situation. I'm Kris Dureau, a licensed life insurance advisor with Harbourfront Estate Planning Services. For clarity, today's discussion is in my capacity as a licensed life insurance advisor. In this video, we're going to break down what life insurance is designed to help do, the most common mistakes people make when choosing a coverage amount, and the framework used to help estimate the right number for a specific situation. So let's get into it. Before we talk numbers, let's get clear on what life insurance is actually supposed to accomplish. Because I find a lot of people have a vague sense of it without being able to clearly explain the problem it's solving. Life insurance is designed to help replace something that would be lost if you died. Usually that's income, but it can also be childcare, household management, responsibilities inside a business, or debts that would fall on someone else. It could also be financial goals like making sure your children can still even go to university or that your spouse can retire on time even if you're not there. The right amount of insurance is the amount that's intended to cover what would be lost or disrupted if you weren't there tomorrow. It's not a rough guess, not a multiple of your salary someone read in an article, but a number that helps keeps your family's financial plan on track even without you. So let's talk about where people go wrong, because understanding the mistakes makes the right approach much clearer. There's 3 common mistakes people make when choosing life insurance coverage. And the third one is the one people tend to overlook. The first mistake is using a rule of thumb without any context. You've probably heard things like, get 10 times your salary or just cover your mortgage. These rules aren't terrible, they're kind of starting points, but they ignore your actual financial situation. Someone earning $100,000 with no debt, a working spouse and grown children needs a very different amount of insurance than someone earning $100,000 with a $700,000 mortgage, 3 young kids, and a spouse who doesn't work. The rule of thumb gives both families the same answer, and that's the problem. The second mistake is only insuring the income earner. This is very common in families where one spouse earns the income and the other stays at home. The assumption is that if the income earner dies, the family needs insurance to replace that income. And that is true. But if the stay-at-home spouse dies, there's suddenly a gap as well. Childcare, household management, scheduling, all these things. And all of that has real value. Replacing that support can be a significant cost depending on where you live and the type of care required. The third mistake is not updating coverage as life changes. The insurance you bought at 28 when you were single probably doesn't reflect your life at 38 with a mortgage, 2 kids, and significantly more income. Life insurance isn't a set and forget decision. It should be reviewed every few years and definitely after any major life event or transition. Now let's get into the framework, and I want to walk through this in a way that's concrete and practical and not theoretical. There are 2 main approaches to calculating how much insurance you need. The first is the income replacement approach. The second is the needs-based approach. Most advisors use a combination of both. The income replacement approach is pretty straightforward. You estimate how much income would be lost if you died and how long that income would need to be replaced. For example, if a family relies on $120,000 of income and needs stability for the years until children are financially independent, the coverage required is often well into 7 figures, depending on the time horizon and existing resources. This gives you a practical starting point. The needs-based approach goes one step deeper. Instead of only replacing income, you identify the specific financial obligations your family would face and make sure each one is considered. You start with debts, your mortgage balance, car loans, personal line of credit, anything that would need to be paid off or managed by somebody else. Then you add immediate expenses. Funeral costs in Canada typically range from $10,000 to $15,000, potentially even more. Depends how fancy of a funeral you want. Estate administration, legal fees, and the final tax return could add another $5,000 to $15,000, depending on the complexity of the estate. Next, you add future obligations. University for each child can range from anywhere from $70,000 to $120,000 at today's cost, depending on whether they live here, at home, or potentially even another country for school. Then you consider income replacement. And this is the step that most people skip. You subtract what you already have, any group insurance through work, and any other assets your family can rely on. You may also consider your spouse's income. What remains after subtracting those resources is your actual insurance gap. That is the number you're trying to cover. Now let me show you an example of how this type of calculation can come together. This is an illustrative planning worksheet to help estimate a coverage range. It does not replace a personalized review. Okay, so as I mentioned, we're going to just do a quick run through here on a tool we use to help clients identify their gap and how much life insurance they actually need based on their answers. We have two fictional clients here, and we'll just jump into the areas that we had mentioned in the video. So you can see down here where I'm just kind of putting my cursor and highlighting to a certain degree is final expenses. We had mentioned that roughly with executor fees and things like that, legal fees, there's another column for it, but we're just kind of grouping it in one, plus burial, you're roughly around $25,000 or more. Emergency funds, we just throw about $10,000 in for the unexpected things to come up, to something to think of. This couple's mortgage is $600,000. Doesn't mean that they each need $600,000, but if one of them passes away, that coverage has to be in there so that if one of them passes away, that $600,000 mortgage is paid off. They each have combined loans for other things, such as a vehicle and a couple other things of $20,000. So once again, if one of them passes away, it's going to pay that off. They have one child. We mentioned that the education in Canada for a 4-year degree could be potentially anywhere from 80 to 120 grand, depending if they go away or not. So we've put the 80,000 in here for the child, because if one parent passes away, you want to have the additional funds to help support the child in whatever education route they go. And then here now is a long-term need. So this is the part that kind of gets forgotten a lot about. People know there's mortgage insurance. It's important to pay off the mortgage. But what a lot of couples or younger families forget is that depending on the amount the household spends, it's important to figure out if actual supplemental income will be needed. So Mike makes $100,000 net. Jane is $50,000 net. They have told us that their lifestyle expenses, aside from the mortgage being paid off, would be $75,000 each year. Mike, as you can see, no problem. His income will pay for that. However, Jane would have a shortfall of $25,000 per year. So you could see for Mike, if he passes away, there needs to be extra life insurance there to supplement the $25,000 per year that Jane will need. The next thing to figure out is how many years will Jane need that? And that depends on the couple. Is Jane needed to get her to retirement and then she would have a pension that she could draw on, or have things just kind of figured out after a decade? Is their child 10 years of age and then they feel that once the child's 20 years of age, the child would be out on their own and they wouldn't need as much income? These are some of the factors to think of. But as you can see, because of that, it adds $213,255 extra to the amount of life insurance Mike needs. Now, as we mentioned in the video, to give you that gap and to subtract from what you already have. So if there's employer life insurance, such as there is here, Mike has $200,000 and Jane has $100,000, you would subtract that. If there were other areas here that you felt would not be needed or that could be used to subtract from the amount of life insurance that you need, well, then you would do that, and it would bring down the total amount of life insurance that you needed to pay. So what this tool does is it kind of puts everything on one sheet. It allows us to identify what the insurance gap is, and based on the couple's answers, it gives us an accurate amount of how much coverage that they actually need. So you can see here at the bottom, the shortfall is $748,255 for Mike and $635,000 for Jane. What this exercise does well is it removes the guesswork. Instead of picking a number that feels right, you're working with a number that reflects your income, your debt, your goals, and your existing resources. And for many people, that result is either higher than expected or structurally different than what they currently have. Now let's talk about the factors that move this number up or down. Your mortgage is usually the biggest driver. A $900,000 mortgage in Toronto creates a very different insurance need than a $300,000 mortgage in a smaller rural setting. Your spouse's income also matters a lot. A dual income household where both spouses earn similar amounts has a very different insurance need than, say, a single income household. If your spouse earns $100,000 and could sustain the household independently, you may only need to insure the gap rather than the full lifestyle. The age of the children is also another major factor. Young children mean a longer runway of financial dependency. A 35-year-old with a newborn typically has a higher insurance need than a 50-year-old whose children are finishing university. The need naturally decreases as children become financially independent, and your existing assets also offset that need. If you already have significant savings in registered accounts, non-registered account investments, that wealth already provides a level of financial protection for your family. You don't need to insure money you've already accumulated. One final point before we wrap up. How often this number should be revisited. Life insurance isn't a one-time decision. Your coverage needs change as your life changes. And as a general rule, review your coverage after any major life event or transition. A couple examples: getting married or divorced, having a child, buying a home or paying one off, a significant increase in income, starting or selling a business. And even if nothing changes, it's still a good idea to review your coverage every 3 to 5 years. The goal isn't to be overinsured. It is to have the right level of coverage based on your actual life today, not the life you had when you first bought the policy. Here's the key takeaway. The right amount of the life insurance isn't a number someone can give you without understanding your specific situation. It's the result of a real calculation, one that considers your income, debts, goals, existing assets, and the people who depend on you financially. Rules of thumb can be a starting point, but for many families, the real number ends up being meaningfully different from what they currently have. The families who navigate this well do one simple thing. They do the math. They know their number, and they revisit it as life changes. I'm Kris Dureau with Harbourfront Estate Planning Services, Inc. Thank you for watching.